When people ask me when gold is going to move, I say I made substantial additions to my gold holdings in 1998. And it is true for 2 years that the gold price didn't move except for down. But since 1998, the gold price has moved from $256 an ounce to $2,000 an ounce, which is to say an 8 or 8.5% compounded gain for 24 years. When's gold going to move? Well, over the last 2 decades. My suspicion is that the moves become more pronounced in the next 5 years than they have been in the last 20 years.
Gold has managed to regain the $2,000 level after enduring heavy losses, although it remains under pressure amid the Federal Reserve's commitment to combating inflation. Spot gold was observed trading at $2,004.23 per ounce, showing little movement during Asian trade overnight. This stabilization follows a recent plunge to $1,983 on Tuesday, triggered by higher-than-expected U.S. inflation figures. Renowned investor RickRule, known for his insights at Rule Investment Media, contends that precious metals, particularly gold, are historically undervalued and hold significant potential for price appreciation. He highlights gold's substantial gains over the long term, suggesting the likelihood of notable movements in the years ahead. Despite gold nominally reaching record highs, such as the $2,135 per ounce peak in December 2023, Rule notes that when adjusted for inflation, the early 1980s still stand as the gold price apex. He references the Great Recession following 2008 as a period that sparked a flight to safety and increased demand for gold, propelling its price from around $730 in October 2008 to $1,300 by October 2010. According to Rule, the current demand for precious metals doesn't necessarily need to surge 12-fold, as it did in 1981. Even a 4-fold increase would suffice to reward investors and speculators handsomely. On a broader scale, the global precious metals market exhibited a value of $243,584.63 million in 2023, with expectations to expand at a compound annual growth rate of 5.38% throughout the forecast period. By 2031, the market is projected to reach a value of $333,487.65 million, indicating substantial growth potential in the coming years. Let's watch snippets from RickRule's interview, but before getting into the video, make sure to subscribe our channel and give this video a thumbs up.
Do you believe that there's going to be a global recession? Even if you believe there's going to be a global recession, what a global recession will do is push out the peak punch point, the peak shortage, from something like 4 and 5 years from now to 7 years from now or 8 years from now. So in terms of inflation-adjusted returns, the arithmetic suggests that the oil and gas companies are cheap, and they have proven to be effective inflation hedges. But the cheapest sector, I would suspect, is precious metals. And I know in the comment section after this interview goes up, people will say, that old man's crazy. Gold hasn't moved for X amount of time. Why on earth would he be talking about gold? That's precisely why I'm talking about gold, because it hasn't moved. Except, Mike, it has. When people ask me when gold is going to move, I say I made substantial additions to my gold holdings in 1998. And it is true for 2 years that the gold price didn't move except for down. But since 1998, the gold price has moved from $256 an ounce to $2,000 an ounce, which is to say an 8 or 8.5% compounded gain for 24 years. When's gold going to move? Well, over the last 2 decades. My suspicion is that the moves become more pronounced in the next 5 years than they have been in the last 20 years. If that's true, then the gold companies, from the highest quality, the royalty and streaming companies, through the senior producers, through the intermediate producers, through the single asset producers, through the high quality developers, are in historical terms insanely cheap. I'm not suggesting that your listeners put 100% of their net worth in expensive penny dreadfuls. What I'm suggesting is that gold is so deeply out of favor that the market share of precious metals in the United States, the largest savings and investment market in the world, is less than 0.5%, which is to say less than 0.5% of savings and investment assets in the United States are denominated in precious metals. The 40-year mean market share of precious metals is 2%. If the market share of precious metals and precious metals related investments merely returned to mean, demand for these assets would increase fourfold. And I believe that will occur within 5 calendar years of today.
Yeah.
By the way, it's estimated by JP Morgan Chase, and it's only estimated because they didn't have data going back that far, that the market share of precious metals and precious metals related assets in 1981 exceeded 6% versus 0.5% today. That's speculative. You don't need to say that demand is going to increase 12-fold. Increasing fourfold is certainly enough to reward investors and speculators. I mean, most investors in the world can't spell gold, despite the fact that it's a 4-letter word. Your listeners are probably more sophisticated with regards to that. But the truth is that I think that the disfavor that gold and silver find themselves in is a rear view mirror disfavor. It doesn't take into account debt and deficits. It doesn't take into account the necessity to inflate, and it doesn't take into account the historic cheapness of these assets and their reduced market share relative to other asset classes.
RickRule suggests that gold typically leads bull markets in precious metals, attracting generalist investors once the narrative gains widespread attention. As generalist money flows into the market, these investors may notice the relative weakness of silver compared to gold, sparking increased interest in the silver market. However, Rick notes that this surge in silver prices often occurs in the middle rather than at the beginning of a bull market cycle. Drawing parallels to historical patterns, by 1974, silver had notably lagged behind gold for 2 years, but then staged a rapid catch-up rally. From late 1973 to the first quarter of 1974, silver saw a remarkable surge of 125%. This catch-up rally marked the end of the initial phase of the significant bull market of the 1970s. The current bull market began in 2018 when gold reached $1,160 per ounce. Similarly to the early 1970s, silver trailed behind gold for 2 years before experiencing a catch-up rally in the summer of 2020. Over the subsequent 4 months, silver surged by nearly 150%, echoing the historical patterns observed in the 1970s. Let's watch RickRule's interview.
You said about gold and silver. What I've found, and this goes into psychology as opposed to arithmetic, I think, is that precious metals markets are interesting in that they reverberate between both greed and fear, the two great investment stimuli. I postulate that every precious metals bull market is led by gold because the fear buyer predominates. When the fear becomes extreme enough that you get price momentum, the greed buyer comes in. And ironically, the price move is caused by reinforces the narrative around the fear buyer, and the fear buyer increases his or her purchases. My experience tells me, irrespective of the gold silver ratio, that silver doesn't move until the middle of a bull market, that the market needs to be led by gold. When the narrative becomes broad-based enough that the generalist money comes in the market and looks at the relative weakness of silver compared to gold, the silver market absolutely takes off. It moves much faster and much further, but it doesn't move until the middle of the market. We have said before on this show that the most volatile asset class of all are those few relatively high quality silver companies, because there simply isn't enough market cap in that space to hold the generalist money when it comes into the market. If you'll permit me a couple of examples, in the 1970s, Coeur d'Alene, 10 cents to $65. Not a typo, 10 cents to $65. In more recent times, the bull market in the early part of the 90s, Pan American Silver, 50 cents to $45. Silver Standard, 72 cents to $44. You own these stocks not with money that you had set aside for a child's college education, but rather that money that you can afford to lose half of in anticipation of making 10 to 15 times your money. People who are listening to this discussion, please use money that you can afford to lose half of without it changing your decision as to what to have for breakfast. That comment doesn't apply to buying gold bullion or silver bullion. Buy that to sustain your lifestyle. Buy that because you're afraid. Buy that because it's actual wealth. Buy it because it's actual money. The very, very, very high quality producers, buy those as investments. But the speculations that we're talking about, the 10 cents to $65, the 72 cents to $44, use money that you can afford to lose half of without it changing your decision as to what to have for breakfast. With regards to the oil stocks, only buy them if you drive or use energy. In other words, everyone should own them.
A high gold-silver ratio suggests that silver may be undervalued relative to gold. In December, this ratio stood at 81 to 1, significantly exceeding the modern average range of 40 to 1 to 60 to 1. Since then, it has increased by another 5 to 10 points, currently surpassing 90 to 1. What implications does the current high gold-silver ratio hold for investors, and how might this impact their investment strategies in the precious metals market? Share your thoughts in the comments section. If you liked this video, please like, share and subscribe our channel and click the bell icon to be notified of future videos. We hope our content has helped you in your trading endeavors.